I've got a very special guest on the channel today. Her name is Cathy Stacey, and she works with my legendary favorite economist, Phil J. Anderson, who has written this book here, which I reference quite often on the channel. So Cathy works with Phil on property share market economics. You can check it out on the internet. I've got links to that in the description. The reason why I've got her on the channel today is that I want to discuss the economic cycles. Now, we talk a lot about stocks on the channel, but everything ties in together. And I believe if we want to be the best investor that we can be, we need to understand what's going on out there in the financial world. We need to understand land prices. We need to understand stocks. We need to understand all sorts of different investment vehicles. And the most important thing that I've found over my career is understanding cycles, and if we can, learn how to time these cycles. So a lot of people think this can't be done. I've seen it with my own eyes that timing the cycles is definitely possible. Now, there are many reasons why it doesn't work out for a lot of people, but that's what I want to dive into in today's video with Cathy Stacey of Property Share Market Economics. This interview was filmed on Friday the 9th of October, and I hope to have Cathy on the channel again. So let me know in the comments down below what questions you have as you're going throughout the interview and other questions are coming up for you. So drop them in the comments down below. If you're new to the channel, hit the subscribe button and the bell notification icon. And if you find value from understanding anything to do with financial markets, timing the economic markets, drop us a like down below. It really does help out the channel a lot. I understand it might be a complex topic for some, so I'll be getting back to every single comment down below. Be sure to leave your questions or comments down there. Now, without further ado, let's jump across to the interview with Cathy Stacey. All right, guys, so I've got Cathy on the channel. Thanks again for joining us, Cathy. We just want to get into the property cycles and understanding what it is and why these things are helpful for us in our own investing. So, let us know your brief background, current position, what you're doing now, and then we'll dive into the questions.
My brief background. Thanks, Jason. Let me start with what I'm doing now. I work with a couple of guys, Phillip J. Anderson, Phil Anderson.
Yep.
He's the author of The Secret Life of Real Estate and Banking.
I do the same thing on my channel. I pick it up. It's so ruined that I just have to show it with the hardcover.
Matchy.
Yeah, so you're working with Phil now. This is direct knowledge with Phil. Yep.
I also work with Akhil Patel, and he's based in London, and he's an economic cycle expert. He also works for the European Bank as a policy advisor and has many master's degrees in economics and this, that, and the other. But then as a young woman, I became a police officer, and I was an operational police officer for about 8 years, and then I became a lecturer at the police academy, teaching recruits.
Okay.
My brother was also a police officer, and so that's how I got into it. I bought my first property at 19, and I also started to do some trading. I was terrible at it. I had no idea what I was doing. And I knew somehow that property was a good thing to invest in. We're talking decades ago.
So we had a property boom at that time. We had stock markets not doing too much, and then we got into the tech rec area.
Well, in the early 90s, I was a police officer, and unemployment was so high. Interest rates were so high, and I remember having conversations with other people, being thankful that I had a government job. I had bought my first property by then, and interest rates were super high, and so I was again thankful that because it was an investment property, that I had a job that I could pay for the mortgage repayment. So I remember living through these really bad economic times. But when I say economic times, it's about people, and how people suffered through those economic times, because economics is about people. After about 10 years, I started my first business, and I would travel to outback cattle stations and teach the jackaroos and the jillaroos emergency management and first aid and stuff. And then I had another business, and my company owned the Victorian franchise rights to a fitness business. We had about 64 franchises in our network here in Victoria. I sold about 5, 6 years ago. I think it was a good time for when I sold. But what actually happened Jason, in the GFC, the global financial crisis, is I had some family members leading up to the crash who went overseas to the UAE, to Dubai and Abu Dhabi, and they started to buy and sell property. And they did so well. But not long after that, the GFC happened, and they lost just about everything. So it was devastating to see them in that state, to see them suffer, because they didn't do anything wrong. They did things really well, but it was the timing of it. I didn't understand about timing back then, so I started to research why did the GFC occur. And the first thing was why I wanted to do that was so that my family members could never be in that position again. And it took me about a year, and then I found Phil, right? So I found Phil, and
must have been the time when the book was released.
I met him in 2011, and then I went to a seminar of his. Now, I had been researching why the GFC occurred, trying to understand the cause of it, and I couldn't find. It was all different economists said different things, and it was confusing. But then when I met Phil, it made total sense what he was saying. And then when I read his book, again, it made total sense. It was a hard read, but I forced myself to read it. And I go back, I use it as a educational text. It made sense. And so I then became quite obsessed, to be honest, with learning about what Phil calls the economic cycle and the 18.6-year real estate cycle, because that was really the cause of these booms and these busts. Now, I then realized that I couldn't keep this knowledge to myself and to my family, that I had to be in a position to try and teach as many people as possible. And so I manifested. And so now I actually work with Phil, and I work with IQ, and we have this global business, and we teach people about economic cycles, and it all starts with the 18.6-year cycle. So be careful what you wish for, because
you were mentioning there before about the cycle and how you got into it, how you got interested, and that was one of my other questions, was like, how did you get interested in the cycle? So you've basically answered that, and then it's kind of like, why do you believe that that was the answer at the time? And maybe that spans into a few other questions, but I felt the same when I was reading it, that all the economists say something else. And that was the time that I was going through like my first properties, and that was my first real crash that I could actually experience in the market, GFC. I bought some properties in Brisbane. The market went down, but not that bad, so I didn't really get stung too bad. But all the economists just said everything different. It's one thing led to another, but it was this, it was that. It didn't make any sense. But then when I, read about Phil's cycles, it was like, oh, this makes so much sense. So why do you think that, like, why does it make sense to us but not to others? And why do they still believe it's got to be from the economists and the way that they report data and numbers and not cycles? Is that a clear enough question?
Yeah, it's a really big question, actually, Jason. And I've thought so much about it myself. And I think it comes back to our conditioning. We're conditioned to think when we're born that the earth exists for us, right? And I know during my upbringing, it was all about get a job, pay taxes, and get a roof over your head, and that's about it. And that the government was in charge, and you did what you were told, right? So get a job, pay your taxes, get a roof over your head. Job, taxes, roof over your head, and that was it. In actual fact, what we're not taught is the special nature of land, and how important land actually is in our life. We don't, at the moment, we don't see land. Our current modern day economists don't see land. They don't include land. I'm not talking about the building on top. I'm talking about
Yeah.
land itself.
Yeah,
They
the
don't see
earth, the
land.
dirt, not the depreciating asset of the physical pieces of timber and metal, steel,
That's
bolts,
right.
nuts. Yeah, so
Yes,
the
that's
land,
right.
what don't we see about the land?
Land used to be included in economics.
Uh-huh.
Land, labor, and capital. Land, and then the work we do on it.
Yep.
And capital is what we produce. So the building on top. But about 100 years ago, it was removed. Professor Tippett talks about that. When he first started in economics 50 years ago, it was a discussion. Land was included and then it was taken away. The RBA, if you look at some RBA speeches and texts, they very
Yep.
clearly say Reserve Bank of Australia,
Australia.
and this would
Yep.
be in other Western countries, that land is treated as an asset. Now, yes, it is an asset, but it is actually the cornerstone of our whole existence and our economy. So land existed before any of us, and it wasn't produced. So because it wasn't produced, there's no production associated with it. It's just there. It just exists. And there's a finite amount of it. You
Mm-hmm.
can't make any more. Whereas the
Like
building on
Bitcoin.
top, like Bitcoin.
I'm kidding. I do a lot of crypto on my channel. And I'm really starting to get the sense that it's a very deep philosophical discussion as opposed to the way we have turned it into the science.
Well, if we go back to what Phil has written about in his book,
Mm-hmm.
that on an 18.6 year cycle basis, certain things happen. There's booms and busts, right?
Mm-hmm.
Every 18.6 years. And if you go back in history, it's very, very clear. Even in Australia and other Western countries, it's very clear that there are times of economic booms and times of economic devastation. Young people need to know this because young people have decades ahead of them, and
Uh-huh.
they can really take advantage of the best time to buy, the best time to sell. Now, the reason why, or sell or accumulate or leverage, the reason why the real estate cycle is so important for traders, for investors, for everyone who wants to invest, whether it's the share market or land, is that in the US leads these cycles. It comes back to land values. So
Mm-hmm.
yes, it's a real estate cycle, but land values in the US lead the cycle. And in history, it's very clear that once land values start to recover, it's 14 years of increasing land values, takes it to a peak, then the share market peaks, then there's a recession. And that is an 18.6 year process. So that's why real estate and land values in particular is the key leading indicator of these booms and busts. So the discussion around why and land and how we treat land is quite a deeper discussion. But
All
how
right.
it manifests is in that particular time frame.
All right. Yeah, I kind of got the feeling it was quite deep. And right now we're just talking about 18.6 year cycle. So what is the 18.6 year? You kind of just mentioned on it there. Anything else you want to sort of like add to that to let the audience know what it is and then how does it work? Why does it work? And then we can sort of like move on from there.
I know that we're told because something's occurred in history, it doesn't mean to say it's going to occur again. We're told that all the time. You can't look at past results and expect them to occur in the future. The thing is, there is a thing about cycles. Cycles do exist. I mean, the Earth rotates and the sun comes up and the moon, and that
Yeah,
cycles
we have
do
the
exist.
seasons. Yeah, yeah.
The seasons, the tides, all of
Everything.
that. You simply can't deny that. Now, it also occurs in the economy. And
Mm.
there is another author called Homer Hoyt. And in 1933, he published a book called 100 Years of Land Values in Chicago. So he did this study and he identified that in the previous century that there were cycles in regards to land values, but he focused on Chicago itself. But the important thing about it is he identified particular things that occurred in the economy leading up to a massive peak in land values, and then what happened to the economy after that. And what Phil has done in his book is he's looked at each individual cycle for the last 200 years, and he's also written about those particular things that occur within the economy that repeat over and over and over again every 15 to 20 years, every 18.6 years. So they are repeating, and they don't repeat exactly the same because policies change, but the same outcome occurs.
So that was something else I was thinking of. Is like, have these cycles ever not worked? And if so, how would we know if they didn't work?
Well, we're talking about history, aren't we? And that's why there's so much to uncover, and there's this conditioning that we've been taught. History has shown that when there's been world wars, so World War I and World War II, the speculation in land isn't there because it's a world war and there's other things going on. So when we've had those years of war, world wars, these particular cycles have paused. It's just been a pause because there's other things happening, and speculation is not one of those. Speculation as in speculation in buying land and selling land. Certainly the share market's continued, but not to the same level.
The stock market was even closed for the First World War.
Yes, and then when you look at the Second World War and you look at the charts, it's just as down and then sideways and slowly. But once those world wars finish, speculation starts up again. Speculation in land, infrastructure build starts up again. Those same things start to occur again, and the cycle rip-roars away, and you get this almighty peak and this almighty crash. Now, in the middle of the almighty peak and almighty crash, which is the end of that 18-year period, there's also something that occurs in the middle of that, and that is another pause and another decline in the economy, and that's expected in every single cycle. So that also occurs, but it's not land related. So it has a different effect, and that's what we're seeing now. Yes.
Yeah. So briefly, the 18.6 year cycle is about 14 years up, approximately 4 years down as a recession or depression, and in the middle of the 14 years is a mid-cycle slowdown, which lasts for about 1 to 2 years, but it's not in addition to the 14 years. It's within the 14 years.
Yes, good summary there, Jason. Yes, and again, history shows that. The charts show it. The data show it.
Why do you think then studies say that you can't predict cycles? I get that a lot on my channel as well, where I'll talk about the cycle and there'll be the odd person that will say, it's proven that nothing is forecastable. We can't forecast anything.
When I was doing my research, Jason, I came across a lot of economists that would talk about history. And I thought, okay, great. But their history is 10 years ago or 20 years ago.
Yeah.
And that's it. That's not history. History is 100, 200, 300, 400 years ago. That's history. Shall I bring up a chart?
Let's have a look.
Shall I bring up a chart?
Yeah, please do.
Okay. I'll show you this one first. This one is after World War II. And this is the shape. I think visualizing is the best thing, really. This would be the beginning of this a 18.6 year cycle. And if you look at the late 1950s, there's 1975, 93, 2011. Now, this is in the US, and other Western countries follow. And in terms of Australia, if you have a look at the Australian share market, this could be the shape every 18.6 years. It's remarkable. But you start off with 7 years of recovery, but the memory of the previous downturn is still very strong in people's minds. But there is recovery. Then there's the mid-cycle pause. You can see our last one was in 2001, 2002, 2003. And then you have the second half of the cycle, which is the next 7 odd years. This period here, Jason, the winner's curse phase, is really the most dangerous phase. And actually, Fred Harrison, who's another amazing economist in the UK, and he's written a book called The Power in the Land. He talks a lot about the winner's curse phase. And this is the phase where my family members, where they got caught up in buying and selling property. Because the second half is where asset values really take on. They have a life of their own. Future values are brought forward, and speculation goes nuts. And people have this fear of missing out. And those that shouldn't be in the market tend to be diving into market, which takes it to its ultimate peak. You can see that 07. Now, 07 was the share market peak. I think in the US it was October, and in Australia it was in November 07. And then you have this crash. Now, the reason why this crash and 4 years of economic devastation is because what has peaked first is not the share market. What's peaked first and started to come down is land values. And in the US, land peaked in July 06. If you go back in every other cycle, land peaked before the share market. So that's the leading indicator. Different in Australia, but in the US, that's the leading indicator. Yeah, Australia and other Western countries, we follow the US. The US is still the largest economy in the world. So we've never gone into recession.
That's another why that we use the US, because it's the largest economy in the world. So it's pretty much dictating it at this point.
Yeah, at this point, that's right. And the US currency as well is a big factor of that. It still dictates the cycle.
With that top, I was just going to ask about the property cycle and the stock market, because my audience is quite heavily into the stock market, but we're talking about property cycles and we're trying to connect the two to see if there's some similarities, that we can get some foresight on the market before we get stuck in this winner's curse. I've read up that property, and you mentioned it earlier, that property peaks first, then the stock market, and then we get the crash. But I also read that the property bottoms after as well. So it looks like does the stock market bottom before the property market?
Yeah, history has shown that in the US, the stock market's a lot more liquid than property. It moves so much faster. This recovery period, it takes 4 years. Yes, a lot longer than the mid-cycle. It's because land bottoms after the share market, and speculation doesn't really start to take hold until after land bottoms and then starts to recover itself. And
speculation inland, because speculation in the stock market has already taken off. For example, the low was 2009 in the stock market, but the land was 2011, I think. So it was like a 5-year down period, or 4.5-year down period.
Yeah.
But for the stock market, it was 1.5.
That's right. And I think the US stock market didn't actually get to meet the 07 high until 2013. So it had to wait for land to bottom and start to increase in value again. Let's get the speculation going again. And that's get the economy. The economy starts to go again once land has bottomed and starts to recover.
Basically, if I saw it on a chart, it'd be like land peaks first, then stock market bottoms first, and then land bottoms second. But the stock
Mm,
market has to wait for that to catch up. Does this? I've only seen this
mm.
really take shape in the US. I haven't looked at the UK chart in a while, but something like Spain, Italy, these other countries, I guess they're not as big. Their stock markets still haven't recovered to the hot all-time highs. So I guess I'm just trying to put that out there for the audience. Is like, how do we then apply this knowledge into other areas of developed Western countries? Is that possible, or is it really only for US, UK? It was a lot of questions in one, but do
Yeah,
your best, and I'll try and remember that. Yeah,
yeah.
yeah.
Yes.
So really, the
Um,
first thing is, does it apply to all other countries in the Western world developed, or is there something else we should be looking at?
from an overall perspective, the US leads these cycles. So even though our share market hasn't gone to the heights it usually does before this mid-cycle slowdown, because the US had this almighty crash with the pandemic, Australia has to follow. Whilst the values of land can be privately captured,
Mm-hmm.
so the individual person can privately own it and keep it to ourselves, whilst that occurs and we have credit that is dedicated pretty well to the speculation of land, for people to buy land, when those two things occur, we will always get a situation where the economy goes through this 18.6-year cycle. But I know in Australia, our land market is not the same as the US. We don't peak at the same time. We don't bottom at the same time.
All right.
Our share market does, and our economy does. That's perhaps why it can be so confusing.
On from that, we've talked about, has the cycle ever not worked, and why, and then the signs leading up to that. A quick answer to that: do we see that happening this time or next part of the cycle due to wars with China or stuff like that are talked about with US?
Well, it would need to be a world war. Remember, it comes back to the speculation in land. If speculation's not occurring and our countries are focused on a war, that will pause things.
We've seen that in history, Vietnam War, all these other wars in between, the Gulf War, speculation continued. It didn't have any effect on the real estate cycle. I think that's a good point to remember, that all these other, I wanted to call them minor wars, but a war's a war, but it's not world war. They haven't had the effect
Yeah.
on the property cycle.
Yes.
Yeah.
Yes, that's right. It may have some localized effect. What history has shown, the world wars have interrupted these booms and these busts. Paused them.
Paused them, and then they basically took off from that point again. They didn't try and play
Yes.
catch up. They just started their 18-year-ish from that point again.
Yes. And perhaps in another video, I can take your listeners back 100 years with the Australian share market. And then
Ooh,
we
that'd be
can
interesting.
see, you
Yeah.
can see the impact. It's so visual. You can't deny it because it's actually, or it's
It's
what's
there.
occurred. It's
All right.
there.
We'll save that for definitely another video. I like that. All right. Moving forward, we've understood the cycle. We know it's around 18.6 years. We know that we're in the mid-cycle slowdown at the moment. What are we looking forward to next? We kind of know that, but what signs should we look for to know when that's starting and then know when it's finishing, this next second phase of the 18-year cycle?
Well, first of all, it comes back to time. So in terms of time, and this might sound crazy to your listeners, but we were expecting 2020 and 2021 to be the mid-cycle slowdown. We'd been expecting that for years
Yeah,
because it
you've
was
talked about it
due.
for years. Yeah, and like
Years and years
I've been
and
following
years.
since 2012, and Phil has said that for a long time,
Yes,
expecting
yes.
late 2019, and so happened to be 2020. But you're making a call 8 years ago.
That's right. That's
Yeah.
right. And he even said that there would be a share market panic in
Yes.
a share market peak in late 2019, January 2020, and then a panic. Now, he'd said that years ago.
Yeah.
So from a share market perspective, From an economic perspective, it was due. 2020 and 2021, the mid-cycle slowdown was due. Now, I know that sounds crazy. You can't say what's going to cause it, right? But from a timing perspective, it was due.
The news articles that you guys were referring to, mostly when it came to understanding, oh, maybe we're coming towards this peak. We don't know what it is. We didn't know it would be the China virus or anything like that, but we are seeing things happen in the news that show us this is the direction.
Yeah.
Can we talk about that just a little bit to understand the mid-cycle and the end?
Yeah. You can tell when something's coming to a peak when you have people, authority figures, saying things like, boom, the bust, there will never be a bust again. Boomers and busters are over, like Ray Dalio, for example. There's no such thing as a bust. It's all over. Now, that happened at the beginning of 2020. You've got President Trump at the State of Union address talking about how the US has never been in a better position than it is right now. When you look at those, it tells you, okay, we're at a peak now, because it's like the memory of the previous crash starts to fade and it's hard to see it happening again. That's when you know you're close to the peak or at the peak.
It's really getting more into, like, I talk about market sentiment, human psychology, as opposed to let's look at economic data, because we can overstep anything. Our emotions will take over any sort of data. It doesn't really matter.
That's what takes it. The emotions take it to the peak.
Yeah.
So let's do another example in the sphere of your specialty, Bitcoin.
All right.
So when was the Bitcoin peak? It was
2017, December 17th or 18th, right around the seasonal date.
Yeah.
Yeah.
So I was living in the Surf Coast here in Victoria at that point, right? Yeah. And we have, in a lot of those communities, private Facebook pages. The amount of people on these pages asking how to buy Bitcoin, how to do it, people who've no idea about it, no idea. And I was seeing this and I was so fearful for these people. But that told me a peak is coming. A peak is coming. They're the signs to look out for. When you've got when you've got family members saying, how do I buy stocks?
Yeah.
How do I do this? How do I get into the market? You're coming to the peak. That is not the time to get in. The signs are right there.
Mass hysteria, people wanting something, and the FOMO is so real, it's unbearable.
Yes. Yeah.
It sounds way too simple now. The 18.6 year cycle sounds way too simple.
I know.
You need to have some deeper economic data to back this up, but it's all there.
There is economic data, because
whole new conversation. All right.
Yeah. Well, there is, because you see the land values.
Yes.
Right?
Okay.
The question to be asking, Jason, and for your listeners is, well, why don't we track land values? Why do we see the share market?
We track property prices.
Why do we see the share market? But why do we not have this public viewing of land values? Why do we not have that? Does the council
keep that? For in Australia, does the council keep that? Like when we get your rates notice, it's like, this is what your land's valued at now.
Yeah. Can you go back and see the last 200 years of land values easily? You can't.
Not easily. No.
You can't. You've got to pay for it. It's very difficult to find.
Do you think they're doing that on purpose?
Who are the most wealthiest people in the world? And what do they own?
Land.
They own land. Whilst land can be, the value of land can be privately owned. Whilst that can happen, we will always have the situation where the main thing that causes these booms and these busts and this devastation is the private ownership of land, and who captures the value of land. It creates such wealth for people. That's going to continue to be hidden away. I don't know if I've explained that very well, but that's the thing that creates the most wealth in the world.
Sounds like it's turned into a conspiracy. Sounds like
I
a
don't mean
conspiracy video for, yeah,
well.
but I
Yeah, I
love
don't
them.
mean it to be that. But when you think about it, it makes sense. It makes
Uh-huh.
sense that, well, the thing that causes these booms and busts and keeps the confusion going.
Mhm. We definitely see the confusion
We
as
see,
people saying, what are
and
we going to do next? We're going to lump some green tax here. We're going to put a tax on something else and a tax on this. And it's like, that's never really going to fix the underlying issue. The cause of it is the land price. I think we'll leave that for, let's go into that in another video. So you guys, if you're watching, be sure to subscribe down below, like the video, all that sort of good stuff. But we'll talk about it in another video because Phil's talked about his views on how to prevent this from happening in terms of politics, removing all taxes and how that's possible, except for a land tax and all those sorts of things. So if we can, we'll talk about that in future videos because that's another deep discussion.
yeah, I think that's great, Jason. You know, if your listeners are serious about making good money, financial freedom, wealth, whatever it is that turns them on, because it's different for each person. If they're serious about that, they actually have to know a little bit more than how to read a chart. Because then if they know a little bit more than how to read a chart, they won't get caught out like you can. They understand what drives the economy, then they'll be forewarned. And that's what this is about.
That's a nice warning for people. Look, I think we've talked about a lot here. There's a lot more to cover, but I think time's getting beyond us. Guys, if you are enjoying it, obviously let us know in the comments. If you have other questions regarding the cycle, then be sure, let us know in the comments and I'll try to schedule another chat with Cathy. That's cool. Maybe not as long, and we'll do some more, quicker videos, dive deeper into those questions, and then maybe discuss news items as they come up, every so often, every fortnight, month, whatever we can fit into your schedule, and just explain how that is affecting or working in with the cycle of property, with stocks, with whatever's going on in these macro views.
I'd like to talk about credit at some point, Jason, but we have to talk about it. We have to. We've got to talk about what credit actually means to the economy.
Okay.
What it means, and then how credit manifests into the share market and property.
That leads to this big
because
boom
it's
and
not
bust.
what people think. It's not what people think.
All right.
They must understand this.
Excellent. No, I'm keen. We can both talk forever. So we'll leave that for another video. The taxes, land taxes, removing all taxes, how politics should work, credit in the cycle. We'll punch that into another video or three. Comments down below, like up the video, go across to propertysharemarketeconomics.com. There'll be a lot of information there. Plus there's a free membership to go through and understand, just start to get a feel for how this news plays out in the market. Any other links, socials that you want to mention before we wrap it up?
Facebook is Property Share Market Economics, and we like to respond to what's happening economically speaking, and our take on that, and Twitter and so forth. But if you go onto the website, and then you can download a couple of the free ebooks. So if you go onto the blog page of the website, there's an ebook that I've written, but there's some great charts in there as well.
Beautiful.
So start with that and have a look at those charts. It tells 1,000 words.
Thanks, Cathy. I know it was a long one. I really appreciate your time, and I'm really looking forward to the next interview.
Thank you, Jason. I appreciate that.
Thank you so much.
I hope you enjoyed that interview with Cathy Stacey of Property Share Market Economics. As I said, you can grab the links to the website down below and also pick yourself up a copy of this fantastic book by Phillip, The Secret Life of Real Estate and Banking. It's on Amazon, and I should have a link to that in the description as well. Guys, if you found value from the video, be sure to leave it a like down below. Hit the subscribe button if you're new here. We cover everything in the investment world, especially stocks, cryptocurrencies, and the land property cycle. Drop your comments and questions down below for Cathy or myself, and I'll get back to those as soon as possible. I look forward to seeing you guys in the next video, and until then, have more fun to get more done.